Hello everyone, welcome to our Egyptian online seminar group. First, keep your microphones off. Then, if you have any questions, you can open your mic and ask our speaker during her presentation or after her presentation. I have great pleasure of welcoming Professor Elizabeth. Elizabeth is a professor of accounting at the University of Waterloo. Her recent research interests are related to the role of non-financial information in assessing and predicting firm performance and the impact of disclosure and communications on the firm's cost of capital and the stock price crash risk. Her studies has been published into ranking journal such as Journal of Accounting Research, the Journal of Financial Economics, Management Science, Review of Accounting Studies, the Harvard Business Review. She is an editor, Journal of Business, Finance, and Accounting. She obtained her Ph.D. in accounting from Stanford University. Now we will start our seminar with Professor Elizabeth.
Okay, thank you very much, Mohammed. Thank you, first of all, for hosting these virtual seminars. It's been great for all of us to stay connected during these current conditions. And thanks especially for inviting me to present. And so this is a new paper. We appreciate any comments that all of you have on it. And I would like to acknowledge that this is joint work with Jurian Hendricks, who is soon to be a Ph.D. student at Tilburg University, currently a research master's student. Philip Hughes, also at Tilburg, and Baruch Lev from NYU. So the research question that we're addressing in this study is whether ESG scores are important indicators for share price resilience during the COVID-19 crisis, incremental to other known determinants of returns. And so one of the reasons that we were motivated to undertake this study is that there has been a tremendous amount of hype in the financial world, in the media, and on the part of those who are selling mutual funds, who are constructing indices, and or who are selling ESG related data. And the loud message that was coming out, particularly at the end of Q1, when the first quarter tabulations were done, and the claims that were being made at that time is that firms that are high performing on the basis of ESG outperformed their counterparts. And Morningstar went so far as to say that ESG was an equity vaccine during the pandemic-induced market declines. BlackRock, Morningstar in relation to their funds, MSCI in relation to their indices, and others, and again reported widely in the leading financial newspapers, magazines, and blogs around the world, were claiming that ESG was a resilience factor for share prices during the crisis. As time evolved, and I think people got over that first Q1 shock and stepped back and took a bit of a breather and contemplated not necessarily doing the data analyses that we have, but sat back and looked at the composition of some of these ESG funds. And those firms that actually did outperform, there began to be some skeptics that emerged. And they have suggested, for example, in the Wall Street Journal, that the fact that ESG-oriented or high-scoring ESG firms outperformed may be attributed to luck. The Financial Times suggests that firms that have high ESG ratings are also associated with particular industry memberships, and those industries performed better during the crisis, or alternatively, those with low ESG scores were from industries that performed particularly poorly during the COVID crisis. And that firms with high ESG scores also have higher credit ratings. And obviously in a time of crisis, those financially more resilient firms are also likely to perform better. And so, basically the skeptics emerged to suggest that it was something other than ESG that was driving the returns performance of high ESG firms during the crisis. And so we consider this investigation into ESG related performance to be an important one. So this graph, I'll get to my sample, our sample determination momentarily, but the study is done with US data. So this is also a US based, US data-based graph from Morningstar. And it's showing the fund flows into sustainable investment funds. And you can see that 2019 was an extraordinary year. And the 2020 figures to date are only through June of 2020. And the updates that I have heard through the summer were also correspondingly high. So by all accounts, 2020 will be a record-setting year in terms of fund flows into sustainable investment funds. And notably, a big chunk of what happened in Q2 of 2020 actually happened in April of 2020. So after we went through that March, late February through March market meltdown, and around the time that all the reports were coming out, that high-scoring ESG firms were the ones that were outperforming during this crisis period. And so the economic magnitude of what's happening here and the potential for asset shifting is in our minds non-trivial. From an academic perspective, there's also, of course, quite a bit of debate about how ESG-oriented firms perform relative to their counterparts. And so there's mixed evidence over the long run as to whether ESG firms outperform. I think the evidence is now leaning more, that's my take on that literature, that over the longer term, I think ESG firms do tend to outperform. I believe that's where the preponderance of the literature is now leaning. But we're actually specifically looking at ESG performance during a period of crisis. And so there are a couple of perspectives that are relevant in this context. So Godfrey et al. And others have suggested a stakeholder-based approach to CSR ESG related activities. And they suggest that investments in these kinds of activities help to build social capital and trust with the firm's constituents, their stakeholders. And that includes employees, customers, suppliers, government agencies, society at large, and so forth. And the idea is that when crisis hits, when times are difficult, these bonds that have been established pay off because stakeholders are loyal to the firm, stick with the firm, and help them to endure the challenges during a crisis period. So this perspective suggests that ESG-related investments offer downside risk protection. Lynn, Cervez, and Tamayo find evidence consistent with this. From the global financial crisis period, they find that firms with higher ESG scores have better returns than their counterparts during that particular crisis. Another perspective comes from the agency theorists who suggest that a lot of this spending or some of this spending on ESG related activities is being done with shareholder money, but it's actually being done by the firm's executives in order to boost their own reputations and to further their own entrenchment within the firm. And there's evidence to suggest, supportive of this perspective as well. Liss et al. Suggest that ESG expenditures generate insufficient returns and actually reduce shareholder value. And so in our particular context in the time of crisis, if this is what's going on with some of the, or the preponderance of the high ESG scoring firms, is that this is wasteful expenditure that is designed to support a management entrenchment strategy, then you have not great managers being entrenched and wasteful expenditures, and that should actually play out worse for firms during a crisis period. And so which way it's likely to go, I think, is notwithstanding all of the hype, I think there's a fair bit of tension there. And so the data that we're going to use to address this question, most importantly, the ESG data, we're using Refinitive's ICON database. So that's a Thomson Reuters product. We are focusing on US firms. And all of the other data, we list that in the paper. It all comes from standard sources. So CompuStat and and the like, WebEx and or BoardX and so forth. So for our principal analyses, we end up with 1,652 firms for Q1 of 2020 with the available data necessary to undertake our analyses. And as a supplementary set of analyses, we do look at Q2 of 2020. Our sample is reduced slightly during that period because of there were actually delistings, firm failures, and there was some data not available for firms that delayed their filing. And so we didn't have Q1 2020 data for those firms. So our sample is reduced slightly for the second set of analyses. And feel free, by the way, to ask questions as I go, if you have any. So descriptively, there's not too much really to highlight here, except to say that buy and hold returns are negative as expected. The raw returns on average are about 32% over this first quarter period. I'll mention as an aside, so we're looking at the whole of first quarter returns, so January through March. We do untabulated specification checks just using the intense crisis period, if you will, that started in late February when Italy recorded their first death and went into lockdown. And that's when the Western markets really responded and understood the implications for the global society and our economic situation. So we've done specification checks just using that shorter period, but because that is really where the action is on returns, it doesn't actually change anything because that period completely dominates the first quarter return measure in any case. So significant negative returns as expected, as we know from Q1. And then the other thing perhaps worth pointing out is that the ESG average measure is about 47 out of a theoretical maximum of 100 and unreported in this table, but the range of that variable goes from about 7 to 95. So there's a considerable amount of cross-sectional variation on the ESG test variable. In terms of correlations, simple pairwise correlations, a few things are probably worth pointing out here. First of all, ESG scores are positively correlated with buy and hold abnormal returns. So this is broadly consistent with the story that's out there, which is that high ESG scoring firms also had higher returns. And the buy and hold are market adjusted buy and hold returns. So, in simple descriptive terms, our data suggests the same thing as what's been discussed in the popular press. So while ESG is positively and significantly correlated with the buy and hold returns, the magnitude of that correlation is really not that high. It's statistically highly correlated, not so much economically in terms of magnitude. Notably, cash and the firm's stock of intangible, internally invested intangible assets is much more highly correlated in terms of magnitudes and also as statistically significantly correlated. And the firm's long-term debt and short-term debt positions are negatively correlated with returns. So these are, I'm going to say, very intuitive pairwise correlations in terms of their signs and their magnitudes, but notably much more important than ESG, even in this simple pairwise context. In terms of the RD, what we have labeled here, RD underscore SGA stock, I'll just define that variable because it's going to be important. What we're doing with this variable is trying to capture the firm's investments in internally generated intangible assets. And so as we all know, this is the US, so R&D is basically fully expensed, and marketing and other such expenditures are also expensed in the year incurred. And so we're trying to capture the notion that even while the accounting system is expensing these expenditures, the firm is actually investing in intangible assets. And so what we do here is to capitalize R&D and also to capitalize 1/3 of SG&A to proxy for expenditures on marketing, brands, human capital development, and so forth. And so we capitalize those and amortize them over an assumed 5-year period. So this is the stock measure that would be on the balance sheet if that were in fact the accounting model. And of course, we've adjusted the numerator in ROA to add back the portion expensed and in the actual accounting statements that we have capitalized, and then to remove that portion that we amortize. And so the primary regression specification that we're going to use to test our hypothesis is as shown. So we have buy and hold abnormal returns as our dependent variable. Our test variable is the ESG score. And as I mentioned, it turns out that the investments in internally developed intangible assets ends up having a role to play. And the rest are, I guess in the interest of time, I won't spend too much time on them, but they're market-related risk proxies that we know to be associated with returns. We're capturing the firm's financial flexibility by having a liquidity proxy in there labeled as cash. Obviously, their debt, short and long-term debt. We have some performance-related measures in there, accounting-based performance-related measures in there with ROA. Adjusted as I've previously described, a loss indicator, inventory turnover. We're separately including acquired intangibles that are reflected on the balance sheet, dividend payout ratio, because that was a big part of the discussion in the financial press around this time. We have a couple of proxies in there, the mean earnings announcement speed and the count of internal control weaknesses to try to capture for financial reporting quality. And then a few firm-related variables like size, market share, firm age, and analyst following, as well as proxies for the long versus short-term orientation of investors, institutional ownership, and so forth. And so we view those, frankly, as control variables. We don't have a particular story in mind to tell with those variables. We just want to control for other known determinants of returns in order to critically examine whether this assertion that ESG is driving things during the crisis, incremental to other known factors, is in fact going to hold. And so our results are shown here. And so in the first column, all that we have included is the ESG score and for industry dummies. I forgot to allude to the industry dummies. We definitely have industry indicators in there for obvious reasons. Intuitively, we know that some industries were particularly hard hit by the COVID crisis, and some of them are frankly thriving in the IT space. And so we feel obviously it's important to control for that. And so in our first column here with ESG only in the model, even after controlling for industry indicators, we see that ESG is significant in explaining returns. And so this is, again, consistent with all that's been reported in the financial press, that ESG is positively and significantly associated with market adjusted returns during Q1 of 2020. As soon as we put in some market-based measures of risk and control for those risk characteristics, ESG becomes considerably less significant and almost insignificant. And in the final two columns, when we add in incrementally the set of accounting variables that I alluded to, and separately in column 4, fully specified regression with all of the other firm-related variables, firm-related characteristics, we see that ESG is no longer economically significant. And so once it competes for fundamental market-based measures of risk and accounting-based measures of the firm's flexibility, their financial performance, and some attributes of their asset holdings or intangible investments, then ESG is no longer part of the story. It's economically or statistically and thus economically insignificant. And so intuitively, similar to what we saw with the pairwise correlations, cash is positively and importantly statistically significantly associated with returns. So we're heading into a crisis here. The market is down by 30+%. Intuitively, firms with more cash, more liquidity on their balance sheet and lower debt burdens are the ones that are expected to do better, to survive the crisis as it when it hit unexpectedly.
Elizabeth,
Sorry, go ahead.
One argument could be behind the decline in the magnitude of the coefficient on buy and hold return of ESG could be that the noise in the E and the S and the G, right?
So yeah, so we actually separately, to reconcile with some other studies that are out there, we actually separately run it with ES because, governance is maybe not part of this story as much as E and S are, which is more in line with CSR, if you will.
Mm-hmm.
Our results hold with just ES in there separately.
Did you consider looking at the gap? Because there is a gap between what the company is claiming to do and what the business press is perceiving that the company are actually doing. Did you consider to look at that?
We do not in any way. So first of all, just back to the ESG scores that we are using. These are as reported by Refinitiv. And so the way that they, and this varies, as I'm sure you know, across data providers, the way that they collect their data, it's using only publicly available information. So they're not doing private surveys of the firm and so forth, as some of the other data providers do. So they're using only publicly provided information. And we do not contemplate any kind of a greenwashing proxy or anything like that. We use the data as provided by Refinitiv.
Okay. Thank you.
Thanks for that question. And so the other thing that, again, I'll mention is, as we saw with the pairwise correlations, this.
May I ask a question, please?
Sure.
Yes. I'd like to thank you first for working out this interesting paper. It's quite important in the meantime. But I do have two questions. Probably I have joined the meeting a bit late, so maybe you have reflected on these at the beginning, or maybe not. Which methodology are you using here to run these regressions?
Which methodology? These are just simple linear multiple regression.
Linear multiple regression, okay.
Yeah.
And my second question is, this is a cross-sectional study, and as you know, cross-sectional study gives just a snapshot of time for the analysis you are doing. So I'm not sure how do ESG behaved before the COVID-19 crisis. So it's usually when we do cross-sectional studies, we look before and post, prior and post, but since post is not possible because we're already working with the latest data. So what happened? How did ESG behaved before the crisis?
And so, well, first of all, ESG is not our dependent variable. So we're not trying to model ESG. We're just using it as an explanatory variable. And also, but you do raise a good point for clarification, which is that the ESG scores that we're using are from before the crisis. So this is data that would have been available for investors to make use of, for example, at the start of the crisis. And so we don't, that would be if one were to actually do an investment model as this regression analysis might capture, for example, then this is the data that they would be expected to use, not something that was happening in ESG in years prior for the firm. Unless, of course, they wanted to include some kind of a delta ESG because they wanted to capture the trend, but that's not something that we contemplated, nor is it the assumption or the assertions that have been made about ESG performing well during the crisis. And I did mention perhaps before you came on that we're specifically interested in how ESG performs as an explanatory variable for returns during this crisis, not in the longer period, not over many years and so forth. It's specifically in the crisis because those are the assertions that were challenging that have been made in the financial press. Okay, thanks. And so just to mention again, the our variable that captures internally developed intangible assets is highly statistically significant, positively associated with returns, and also economically significant as well. So much more important than ESG are actually intangible assets, cash, and your liquidity position, and the leverage that you have on your balance sheet when the crisis hits.
Hi, Elizabeth. Could I ask a question about that variable? I'm just,
Sure,
thanks for the paper. It's really interesting. Good work.
oh, thanks.
The ESG measures, so essentially that's capturing a score by an outside party rather than some sort of notionally pure, is this really a better performer or not? But the expenditures, so you've presented the agency theory that would suggest the manager might be overspending on ESG to increase his or her value in the future job market or something through the reputation. So where would those expenditures actually end up in the accounting data? Because it's possible, it occurred to me, that they could end up in this measure of intangibles, like investment in R&D, for example, or SG&A, because you're talking about human resources, you're talking about changing processes and systems to make the company essentially more resilient. So I just wonder how that might somehow partially explain what you're finding. Thank you.
Yeah, that's a good question. And so, first of all, we don't get ESG expenditures. In fact, that other study, if I recall correctly, used ESG scores as a proxy for expenditures, which is the best I think that they could do, because firms don't break that out for us for the reasons that you alluded to. Some of it is basically research, might be green research, some of it isn't. And then some of it relates to people, but not all people-oriented expenditures are necessarily feeding into the social score either. And so the expenditures are basically not tracked, and you know, could end up in any line item, but certainly some of them are likely to be in there as well. And so one could model whether ESG is somehow driving intangibles, and then is that you know, in a more structured sort of equation model approach. That's basically, you know, that wasn't our research question. What we're trying to address is, are these scores that, you know, everybody's harping on about and hyping, are they incrementally informative? Is this, because people are talking about investing on the basis of ESG scores, and our model basically says, don't do that. Use market measures and accounting-based measures that we have, and you can drop the ESG scores and you're not doing worse.
Yeah, I think it's an important finding that it's these scores. I mean, essentially your finding is around the scores, right? The scores themselves, rather than some more robust measure of an actual ESG performance.
Yeah,
so,
absolutely.
Yeah, to say that these, you know, it feeds into that whole greenwash, or these, you know, the way the methodologies they're using, you have to really look under the hood. So yeah, that's good. Thank you. Thank you for the response.
Thanks for the question. And you're right that we can't observe ESG performance and as you described it, its purest form. What we get are these ESG scores, and these are the ones that people are relying upon to make these claims and to make their investments at the moment. And this is, you know, it's ICON. This is the Thomson Reuters database. So this is one of the prominent ones that is being used out there, not only by academics, by practitioners as well. But your point is well taken. Thank you for that. So another way to sort of consider the same question, instead of looking at the coefficients and the regression, is to do what we've done here, which is an Owen Shapley R-squared decomposition. And so what we're doing here is just saying, of the explained variation, which for Q1 was the R-squared was about 40%. And so of that explained variation in returns, how much of it is due to these various sets of variables? And so most of the returns are being explained by the market-related risk proxies, risk and growth proxies. A big portion of it is also being explained by the industry indicators. Again, that's not surprising. That's what we would expect in the crisis, that the industries were important, and more generally that the finance profession has figured out the risk factors that explain returns. We find that accounting-based measures explain about 20% of the explained variation. Those other factors like institutional ownership and so forth, market share, explain a small percent, 3%, and ESG essentially almost explains nothing, 1% of the explainable variation in share returns. So just another perspective or another form of quantitative analysis to basically make the same point, which is ESG doesn't have an incremental, and that's really, to Kate's point, it's incremental to the measures that we have. Doesn't have an incremental role to play. And we do a similar analysis for Q2. And this is basically exactly the same regression. All that we've done is to augment it by the firm's ROA for Q1 of 2020. And because we had that new information come in for Q2, and to allow it to explain Q2 returns. And the punchline here is that ESG is now significantly negatively associated with returns, and that relation, that significant negative relation, holds up even when we add in all of the accounting, market, and other variables in the regression. And so
I have a question, please, if you mind, if you don't mind.
Yep.
Okay, so in the first quarter, ESG was positively correlated in the first two equations, and then it lost its significance in the third and fourth equation. And now ESG is negatively significant in all the equations. What I'm interested in is the interaction term between the R&D and SDA stock. This is the interaction terms that you have mentioned at the beginning.
Yeah, we have never done that interaction, so I don't think I mentioned that.
Yes.
So RD SGA stock is not an interactive term. It's, if you want to think of it that way, it's an additive term of capitalized R&D with capitalized other intangible expenditures.
Okay.
But no, we haven't even contemplated doing that as an interaction term.
Okay, because when you talked about the basic specification of the model, you mentioned something about an interaction term, or maybe I got it wrong. Okay, so there's no interaction term in this these equations.
None of our variables are interacted.
Okay, it would be interesting, I would say, if you tested how an interaction term, for example, between ESG and RD could behave. Maybe companies which invest in R&D could, for example, mitigate such negative impact of ESG on returns. I don't know, but it's worth investigating, I would say.
Okay, yeah, we can certainly check that out. I'm not exactly sure how I would interpret that interactive variable. We can give that some thought. Thank you.
Thank you.
And so a couple of other variables to note here. The market variables come up, at least some of them as expected. The first quarter's performance is significantly positively associated with Q2 stock returns. And again, this intangibles variable comes up as both statistically and economically significant. And we do the same kind of R-squared decomposition for Q2, and the story is, and there's slight shifting here where the industry becomes more important than the market-based risk measures, but by and large, the story is similar in terms of what does explain the explainable variation. I should also perhaps note that our R-squareds here for Q2 are only 20%, so they're half what they were for the Q1 period. But of that explained variation, it is the market-based risk measures, industry indicators, and company financials that are once again important. And ESG has a little bit more of a role to play, consistent with the fact that it was a significant variable here, but still it doesn't explain too much of the overall returns. And so just to summarize what we have here from these sets of returns analysis, what we find is that ESG is not a vaccine against declining share prices during the Q1 crisis period. It offers no incremental explanatory power for returns. Notably, however, it also doesn't hurt returns in Q1. So for those extreme skeptics out there who are anti-ESG for some reason, have jumped on our paper to prove that ESG is somehow harmful to shareholders, that is not the result that we have at all. It's just not incrementally informative during that short crisis period to all of the other control variables that we have in the model. However, in Q2, it is negatively associated with returns. And so our next set of analyses, we're going to use the global financial crisis period as a basis for predicting, to see whether we can predict from one crisis, the winners and losers from one crisis, and use those to predict winners and losers from the second crisis that we've just experienced. So these are the two major global financial crises in recent history. And they're very different in nature. And that was important to us, even initially in undertaking this study. We actually expected quite different results from the global financial crisis period because it was inherently different. It was a financial crisis, and now we have a humanitarian crisis. So we didn't necessarily expect things to play out similarly as they have, much less that this prediction exercise would turn out as well as it did, given the differences between the crises. And we're going to define a winner as firms that fall in the top 10% of returns during the global financial crisis and subsequently in the COVID crisis, and losers are those that are in the bottom 10% of returns. So because we have an indicator variable now, it's a 1 or a 0 for the top and bottom respectively.
Sherry, can I please ask?
Sure.
Yeah, so on the Q1 results, so I'm just wondering that it could be that different states, this is in the US, right? So they had different containment policies. So the intensity of the policies were different across states. And this could actually drive the performance of firms which are headquartered in certain states. Do you consider taking that into account?
We did not consider that. That is a good point. I think that's more likely to potentially be important actually in Q2 because there wasn't that much extreme spread, I would say, by the end of March over here.
I'm thinking about Europe now, but yeah, that's
but yeah, I could see that being a particularly potentially important variable for Q2. I will say that in terms of, I didn't describe the sample extensively when I put those descriptives up, but our sample tends to be larger firms. And that's just because those are the firms that get tracked by these databases. And so as such, that means if they're larger, they tend to be more all over the place and not restricted to a regional area of activity. That being said, I think it's something worth looking into again, especially.
Yeah, and one thing which is coming to mind is that, of course, I mean, if one could control for exposure to China, I think they could be exposed to different degrees. If you export or import components from China, then that could drive the performance of these firms as well.
Yeah. Yeah, I don't know if we can get China-specific exposure without doing a fair bit of textual analysis to pull that out. We could get international, what percentage of sales are coming internationally, but I don't know if we can get China-specific as a measure very easily. But that's a very good idea. Thanks a lot. And so here in these analyses, what we're looking at again, these are 0-1 dependent variables, and we're looking at only the top and bottom deciles. And so you can see that we have a much reduced sample, and this is specifically using the global financial crisis period data. And so what you can see here is consistent with what we saw for the COVID crisis period. Cash and this intangibles measure are particularly important in sorting between winners and losers. Those two variables alone give us a count pseudo R squared of 72%. When we add in the rest of the array of accounting-based variables, we don't improve. We actually get a worse overall count pseudo R squared, slightly worse, but both in the range of about 70%. We look at the market-only variables, we end up with a pseudo R squared of 92%. So market-related risk variables do an excellent job in sorting between winners and losers during the global financial crisis. This is all within sample. If we combine the significant accounting and market-based measures, we end up with pseudo R squareds of 95%. And we can compare that to just sorting on the basis of their ESG scores. And if we do that, and because we have an equal, we're using the top and bottom deciles, we have an equal number of observations essentially in each bin. This is tantamount to basically a random assignment, slightly greater than 50%. You could just randomly assign firms and in any given draw, get this result. And if we add ESG to the previous market and accounting only model, we basically, we're going from a 95% count pseudo R squared to 95.3. So basically ESG alone does little better than chance, and adding ESG to the other best model doesn't really add anything much. And so we could graphically depict this as we have. These are using ROC curves. And the idea here is that the ROC curve captures, we're looking for the area under the curve where, the best outcome is 100% sensitivity and 100% 1- specificity, which means that you're categorizing all of the winners correctly. That's the 100% sensitivity measure. And you're not categorizing any of the losers as winners, which is the 1- specificity measure. And so, again, the optimal outcome would be 100%, top left, the whole area of the box. And alternatively, a random assignment that would lead you with 50-50 and either half is the 45-degree line there. So that's kind of our benchmark, if you will. So if you look at the green curve, that's the curve that results from investing on the basis only of ESG scores. And what you can see is that green curve does very little better than chance. The blue curve is, and this is also explaining winners and losers within sample and the ability of the model to discriminate within sample. And the blue curve is the accounting-based model, clearly up further and to the left of the green curve, and does a reasonable job. I think the area under that curve is in the 70-something%, which is really a very good performing ROC curve. The red curve is basically off the charts. That's the within sample market-based model for the global financial crisis period, and the area under that curve is 95%. And so that's basically graphically depicting essentially what we saw with those models. What's of greater interest, so that was just essentially a baseline, if you will, showing you the fitted model. What we're going to do now is take that fitted model from the global financial crisis and project it onto the winners and losers from the COVID crisis to see whether the model from one crisis is able to discriminate the winners and losers out of sample for the COVID period. And so you can see the area under the ROC curves here are depicted. So model one was the very simple, extremely parsimonious accounting-based model. The ROC curve of almost 79% is again, a quite excellent performance. The more extensively specified accounting model does slightly worse, but more or less in the same ballpark. The market-based model, you can see it does, market-only model does worse than the accounting-based model. And so this was the same model that did an excellent job within sample of explaining winners and losers from the global financial crisis period, but doesn't do nearly as well out of sample. So that's kind of suggests that it was basically overfitting in the global financial crisis, and thus doesn't fit well out of crisis. When we combine accounting and market models in model 4 here, so the purple box getting blue and red together, it is superior just slightly, frankly, to the extreme parsimonious model that's based upon internally developed intangible assets and cash, the top line. And then we can compare that to an out of sample prediction based solely on ESG, which again is slightly better than chance, where chance would be 50%. The ROC curve here is about 56%. And we can use ESG to try to augment the previous accounting and market-based model. And what we find is that it offers no value, no incremental value in sorting between winners and losers when we project from one crisis onto another. And so the same thing, again, can be depicted with the ROC curves here. So the green is showing you it's very close to the 45 degree line, so does little better than chance. The red and blue here are accounting and market only. They're very similar to one another now. So and with accounting doing slightly better, accounting being the blue line. If we were to superimpose the purple line, which was the combination of accounting and market variables, it would be again further to the left and a little bit higher because the combination of them does a little bit better than either one of them alone. And so our final set of analyses is to take the fitted model from the global financial crisis and project it onto all of our available observations from the COVID crisis period in order to assess where these firms are going to fall in terms of their returns performance. And so we're doing this for all observations. So we're basically here plotting for you the whole distribution of all deciles in terms of how these predictions work out. And so the first couple of models are once again accounting only models. So model 1 is just the extreme parsimonious cash and intangibles, and model 2 is with all the other accounting variables. And they perform very similarly with the very parsimonious model actually once again doing slightly better, which is what we saw statistically here. Model 2 was slightly worse. The more specified accounting model performed slightly worse than model 1 statistically. And that is also true economically in terms of returns here. So a couple of things to note are that if you were to go long in the highest performing predicted performance decile 10, and short in the lowest predicted decile performance, the implied hedge returns are 25%, statistically and economically significant. You know, these are academic hedge returns, obviously. I wouldn't run out and do this. And then another thing to note is that we see that the returns deciles here are almost monotonic through the distribution. So it's not just predicting the tails, it's actually doing a good job of sorting through the population. Model 3 is our market-based model. So consistent with what we saw statistically, it doesn't do quite as well as the accounting-based models. But again, you can see that going through the decile ranks, it does a good job. It's entirely monotonic and does a good job of sorting through the deciles, but not quite so much as the accounting-only model. Model 4 will combine these two, and again, as we saw statistically, so it is true here in economic terms with the returns, this is the best performing model when you combine market-based measures with accounting-based measures. And again, we see a monotonic distribution here through the decile predictions. So statistically and economically highly significant. This is our ESG only model. So one thing to note is the lack of monotonicity through the ranks. So if we were to go long in the high ESG firms and short in the low ESG firms, we would earn a statistically significant 6% abnormal return. But clearly that pales compared to the other ones. And Another thing to note is that with the other models, you could do a long only strategy and that would also be profitable. You don't actually have to do a hedge strategy to be profitable. Whereas with the ESG only model, you're required to hedge in order to get an abnormal return there. And so with a 6% statistically and not trivial economically return, that's actually worse than just doing investments on the basis of the prior 1-year returns. So you're going to do better with the most simple investment strategy of just investing in firms that had higher returns in the past than you will if you invest on the basis of ESG here in column 5. So column 7 outperforms. But neither one of those performs nearly as well as a fitted model that is based upon market and accounting-based measures. So, I mean, these results were, frankly, for us, very surprising. We did not expect that projecting from one crisis into another crisis would yield neither as statistically nor as economically significant performance as what we've observed here. And so just to summarize the prediction analyses, what we found was that the global financial crisis-based prediction model performed statistically significantly within, but more interestingly, out of sample into the COVID crisis period. The combined accounting and market-based model is the model that leads to the most economically and statistically significant hedge returns out of sample. And ESG scores on their own perform little better than random chance, and they add absolutely nothing really to the accounting and market-based model statistically or economically. So just to summarize, we hope to contribute to the debate regarding the profitability of ESG-based investing. And specifically, we are only focused on the COVID-19 crisis period. We, as an author team, and me personally, myself personally, are very pro CSR related activities and doing business with good human and environmentally oriented values. So we're not suggesting that ESG based investing leads to losses or an insignificant difference in returns. Even if it were only the latter, that would still be a good outcome because you're doing good on E&S and you're not harming returns. So that has to be, from my value system, that's a good thing. But in any case, we're only looking at this in the crisis period. So really not like for people to project especially our Q2 results onto longer term investing strategies and suggest that ESG based investing is a money loser. That's not what we speak to. It's just very specifically during this limited time period. And so within that context, we find that accounting based measures of the firm's financial flexibility and its investments in internally developed intangible assets combined with industry indicators and market-based measures of risk are what explains well both within sample crisis period returns, and they offer significant explanatory power statistically and economically for out of sample predictions. ESG has no role to play in this. It offers very little explanatory power within sample, nor does it help us to predict winners and losers from one crisis to another. So ESG was not incrementally significant in Q1, contrary to all the widespread claims, and it was actually negatively associated with returns after controlling for everything else that we know drive returns in Q2. So overall, we conclude that ESG is not an equity vaccine during times of crisis. Thank you very much for your comments and questions.
Thank you very much, dear Professor Elizabeth, for your contribution and your effort. It's really a very interesting paper. Thank you very much. Now, if anyone have any questions, you can open your mic and ask your question. Yes, Professor Mahmoud Al-Naghi, can ask.
Yeah, thank you.
Thank you.
The question is, if a company decided to issue shares to increase the capital base, what are the risks and what are the requirements in recent COVID-19 crisis. Again,
So,
if a company decided to increase their capital base, what are the risks and what are the requirements in recent COVID-19 crisis?
so, well, I would say that I don't know that our study speaks directly to that, except to say that other things being equal, what we've seen is that there is very high demand for ESG oriented firms, notwithstanding the ex post results that we present here. There's been a tremendous amount of money flowing into sustainable investments. And so if one were looking to raise funds during current conditions, it would seem as though it might be helpful if you have an ESG angle to your business. Other things being equal, that would seem to make it more attractive.
Okay.
I have one question. Can I ask a question?
Yes.
I think I saw some of the results with respect to your models, and basically you're doing a cross-sectional regression, and I just wonder, especially during the recovery period, and you found that there's a negative relationship between the ESG and the market-adjusted returns. But actually, and from my observation of your models, my question is, did you actually control for endogeneity? So, if for during the recovery period, it's just my intuition that when firms recover, they get higher market adjustments, then they would do not place emphasis on the ESG. That's why you have negative relationship. So there could be a reverse causality there. So there could be some endogeneity issues in a model. I don't know whether you can go for that.
So I'm not sure what selection model you're what
particularly referring to the recovery period, your regression model. What I'm trying to say is that could there be a possibility of reverse causality, meaning that during the recovery period, like firms, they earn higher market adjusted returns, therefore they do not think that they should put too much investment into ESG. That's why you have a negative relationship. So is that possible? So my question is that reverse causality may exist. So I that's why as I said, I do not know whether you control for that in your classification model.
We don't control for that. So you're suggesting, if I understand this correctly, you have positive stock returns, and therefore you reduce your ESG investing. I don't see why that.
Yeah, I mean, because firms they get higher returns, so they don't see any necessity or need to put more money into ESG. So possibly that's possible to be a negative relationship. So
so they've had high past returns.
But I'm just wondering because so there could be reverse causality, because that's why I asked whether you did control for endogeneity problem, or I mean, because your regression model is so long, there could be possibility of endogeneity issues arise. So as far as my experience is concerned as a researcher, we need to control for endogeneity issues, and reverse causality is one of them. So we need to really look pretty and what exactly can drive reverse causality. I believe there's a lot of literature out there, I mean, that's just my view or an opinion.
Yep. So you're kind of cutting in and out. I'm not sure if I got everything, but I think I understand your point. One thing to note that I think would address your concerns is that our ESG scores are actually taken from before the crisis. And so they are not updated. Those are actually they're not frequently updated in the database. They're updated annually, but we're actually using ESG scores that were available at the start of 2020. And so that variable is basically not changing from crisis to crisis in our analyses. And so in other words, it can't be the case that in Q2, whatever was happening with their returns was leading to a change in ESG related behavior, because ESG is measured before Q2, the Q2 returns.
Okay. Thank you very much.
Okay, thanks.
Are there another? Yeah.
I have just another question about picking up on the funds flow that you showed at the beginning, how like the massive flow of funds into the market. A lot of the, well, first of all, in your first period, Q1, Q2, in Q1, you find a very significant factor on institutional investors.
Yeah.
And then that goes away in Q2. So I just wondered if you had interpreted or looked at that was negative and then it went to insignificant, I believe, or maybe I'm not seeing it correctly. It's not significant anyway. It's in the second quarter. The other thing is the industry, because there were a few things just anecdotally going on at that time. Like a lot of people were piling into the market, maybe day trader type people, and they seem to be really focused on tech. So the tech went up and everything else went down. So I just wonder about those sort of market funds flow, market investor types and those dynamics, whether you might have an industry breakdown, for example, of your sample firms that could somehow inform that aspect of what's going on in the actual market.
In terms of tracking the funds flow by sector or something like that, or in terms of,
or just in terms of your sample, what industries is it in? So somebody could say,
oh, I
it's,
see.
it's dominated by this type of firm, or it's a very evenly distributed industry
Okay,
groupings.
sure. Yeah, we can
Also
easily,
the SIC codes, to what extent would, for example, in our market, they'll have the tech index and they'll talk about the tech index going up and down. And, the resource index is like in the going down. So to what extent do those 2-digit SIC codes actually pick up, how fine are they in distinguishing those parts of the market that are reacting?
yeah. So, well, I think the 2-digit SIC codes are going to be more precise than just using, let's say, a high tech dummy, right? We're allowing greater sector specific variation than if we just used a single one. But we could easily, and I know that we looked at this early on, and I don't want to misspeak because I don't remember what the industry distribution looks like now. That was something that we looked at. Just when we were trying to understand our data and see the firms for which we could get extract the ESG data from the database, since it's our first time working with that data, we could certainly present that as panel B or C or something to table 2, just to give a sense for that. Statistically speaking, one would hope that those industry dummies that we have, because we have, 30 or 40 of them in there, are really absorbing the concerns that you have, so that whatever is left over is being explained by those other variables that are particular, that are incremental to the industry sector. But sure, I appreciate the comment that it would be nice to know what firms we're looking at. Beyond just saying that we definitely have a slightly large firm bias and so forth because of the database inclusion criteria that we don't determine. So thanks. But modeling the funds flows and how that all played out in Q2, there are papers that have started to do that already. So that's we're going to leave that to somebody else.
Are there another question?
Yes, Professor, can I have a question?
Sure.
I'm a PhD student at Technological University and also a researcher on the ESG field. There's one question that confused me, is that during this financial crisis, I think the market crash may lead to a very strong liquidity drain. So I think a potential confounding issue is that how's the ESG stocks how's their liquidity performance during this market crash. Maybe the underlying reasons could, on the other hand, be driven by the market, by the liquidity issues. Like during the market crash, the ESG stock may be easy to be dumped. Maybe they could have higher liquidity. That's why people may choose to dump the more liquid asset first during the market crash. Or on the other hand, it could have lower liquidity. That's why we cannot see the ESG's resilient effect after this confounding result. So yeah, I'm curious, like if we can do more tests on how to split the liquidity effect out of this result.
Okay.
Yeah.
And by liquidity, you mean liquidity in the stock, not the firm's liquid assets.
Yeah. It's the liquidity on the firm. That's why maybe during the market crash, the investors may choose the more liquid asset to dump first. That's why we may confound the result, why we cannot see the resilient performance of ESG stock during this particular crisis.
So honestly, we have not thought of that. I mean, the only thing that I can say with regards to that is that we do have this large firm bias, and so these firms, and I guess we could look at the distribution of institutional ownership. Yeah, I mean, our 25th percentile on institutional ownership is that they're 60% owned by 59% owned by institutions. So these are firms that in expectation are not illiquid. You know, we're not dealing with that left tail of liquidity in the market if we have firms that are so heavily owned by institutions. So you know, we do have that particular aspect of our sample. That being said, there's obviously more versus less liquidity, even in the even in the highly liquid realm of the market. So that's certainly something that we could control for in our regression and see if it has any influence on our inferences.
Sure. Thank you, Professor.
Thank you.
I would have one question.
Yes, Kia Zhu, yeah.
Yeah. Hi, Professor. I'm Kui from Rutgers University, and I'm also a Ph.D. student in accounting. I have a question that is, previous literature, they usually show that ESG can protect the firm like an insurance, but in your finding, ESG actually has no effects on stock returns after controlling for all those like firm financial characteristics. So I was wondering if you think your results are only relevant to the COVID crisis, or do you think like ESG in a broader sense has little effect on stock performance? Like, do you think your results can be more generalized to other like negative events? And like, why wouldn't ESG work during COVID? But according to previous literature, ESG seems to work when there are like firm-specific negative events, like when product recall happens. It seems that the company would suffer less if they have better ESG performance. Do you think it was because COVID they affect all the companies, no matter they have good ESG performance or not? Or do you think, I mean, I'm just like brainstorming, like why wouldn't ESG work during COVID crisis, but it seems that it will work in other circumstances.
So thanks for the question. So I can speak to that a little bit in terms of some of our unreported tests. Our results are similar when we actually do the analyses in the global financial crisis period. So notwithstanding other results that are out there, when we actually, and there are results that are contrary to ours also from the COVID crisis, when we do a fully specified regression and control for those other variables, the results that exist for the global financial crisis also go away. And the results that other people have reported for the COVID crisis also go away. So we can replicate their results, But when we put in the additional control variables, the significance of ESG goes away. And so we believe that it is robust across crises, notwithstanding some existing evidence, if you have a fully specified regression, that ESG is not important to understanding a stock price, a stock's resilience. So we believe that it's consistent across crises, and our out of sample prediction from global financial into COVID also adds evidence to that. We didn't reproduce and try to take down the other studies in our paper. There's no point in doing that, but we know what the results show, and from crisis to crisis, ESG is not a player in more fully specified regressions. We have not in any way attempted to reconcile this with firm-specific crisis types of performance, but that's an interesting thought, an interesting issue to bring up, that on a firm-specific basis, ESG investments in social capital might actually behave differently than when when a global type crisis hits. And so I actually haven't thought more about that. So, but that's an interesting difference in results to note. So thank you.
Thank you so much, Professor.
Okay, thanks.
Anita? Yeah.
I would have one question. So thank you, Elizabeth. I really think this topic is important, and I'm following this from Finland. I'm from University of Turku. I'm a university lecturer. So what I was thinking, I remember that I have been also once a little bit looking at these Thomson Refinitiv scores for firms, and at least when I was looking the Finnish listed firms, I found out it a little bit problematic that these were kind of the largest firms with the highest volume of trading. So I don't know if it's same with the US sample, but do you think this effect somehow relates to this issue that these are like big firms and they have these risk management processes maybe more well established? Or what's your intuition? How would it be with these smaller firms which have lower liquidity and more information asymmetry? And then my second observation is that I think in this kind of crisis, I think the fear is quite important driver of these stock returns. So as you said, it doesn't mean that it wouldn't be important if you don't find that now it played a role. It's just that these kind of returns are very tricky when there is fear and these kind of things.
Mm-hmm. So thanks for the questions. In terms of how it would play out for the smaller firms, I don't know. And the problem is, if we don't have scores for them, I don't know how anybody can trade on the basis of ESG if we don't have any scores tracking that, at least not, larger money doing quantitative type trading that's trying to capture that risk factor. If the scores aren't available, how can you put it in your model? So then it becomes more fundamental investing and people sort of getting a sense for, softer way, if you will, on a firm by firm basis, how ESG oriented a firm might be. But without the scores, it's just hard to activate a model. And so to some extent, the action is in those firms for which we have scores. So I'm not sure, honestly, how it would play out with the smaller firms, because you wouldn't have the money flowing in and out of them without the scores to track it.
Do you think this ESG scores by Thomson Reuters is, I know that recently there has been huge competition between banks. They provide their own ESG scores and there is like a lot of variation. So I don't know myself how how much they give the same scores for the firms, but my intuition is that there is actually quite a lot variation in this. Do you have any any opinions or observations on this issue? How well, or maybe they are black box. We don't know what these banks have in their scores exactly. They sell them, so.
Yeah, so I'm not sure about the bank's measures, but I do know that some of the other large databases that are selling these things, like MSCI and so forth, you're absolutely right. And there are a couple of studies out there that have looked at this and compared the measures, and it is from my perspective the single biggest problem that we have in this space, whether you're an academic or a practitioner, is that these measures are clearly, they think they're capturing the same underlying construct, but they're measuring it so differently that there isn't the high correlation that we would like. And it's fine if the measures are different. If they're highly correlated, they're capturing the same thing when you use them in a regression type context, but that's not what we see. And so that is problematic. And what we would have liked to have done, frankly, is to replicate what we've done with MSCI data. Or others, there are Sustainalytics, et cetera, that are out there. And many of these data providers are now claiming that they provide free data. And so we've gone looking for it on their website. We've gone looking for it in Bloomberg terminals, et cetera, whatever we have access to. And what we've found is that this so-called free data is basically, it's for such a small subset of our firms that we actually can't run the spec check reliably with what's available. And unfortunately, for the moment, none of our three institutions subscribe to any alternative database that would give us enough of a sample to run it. I think it's a legitimate issue. I will say, however, that we're using one of the major databases. We're using the same database as the studies to which we're reconciling. And we did have MSCI data, by the way, for the global financial crisis period. It's just that our subscription lapsed, I think in 2016 or something. So we were able to go back and use that for the global financial crisis period to replicate the results of the prior studies that also used MSCI. And unfortunately, the Refinitiv sample from the earlier time period is too small because they just weren't tracking many firms. And then we don't have MSCI data for the later period. So we can't do a 100% reconciliation without, I think, another $60,000 subscription or something like that, which is not in the budget under COVID conditions. So, but you're right, it's a real issue, and I personally think it's the biggest problem that we have, and we need to get convergence. And maybe it's time to get these things out of the commercial realm so that we get that kind of convergence. And that's part of obviously what's going on in Europe right now with the EFRAGs. They're putting together a set of standards that the EU might well end up deciding to adopt under the initiative that they, or the rule that they implemented a couple years ago. So that might be where we're headed, or it might end up being the IASB that takes it on. We have all those other wannabe standard setters that have agreed to work together, but yeah, we need to get these things converged so that we're tracking similar things. And then if a market for segmented, we're really going to go and get these much more refined measures on this particular dimension. They can have that market, but these summary measures have to converge much better than they have to date. It's an important issue.
Yeah, but good luck with the paper.
Thanks a lot.
There is another question. I think that you have done very well with answering a lot of questions there, dear Professor Elizabeth. So
Okay.
Thank you very much. Ended so all that remains for me to say is thank you everyone that joined us, and I thank you very much for taking the time out to present to us today, dear Professor Elizabeth. It's been really appreciated. Thank you very much.
Thank you very much for the opportunity, and thanks for everyone's comments and questions.
Thank you. I hope to see you soon in Egypt.
I hope to be able to travel soon too, and I'd love to see your country.
Yeah, thank you.
All right, take care, everyone. Thank you.
Bye.
Thank you. Bye.
Bye.